And welcome. This is the Huddle Review. This is Jeff. I'm here with our co-host and soon to have a new show here on the chain, Nick Black. What's going on? Hey, great to see you here.
It's good to be here. Good to be here.
Man, this is awesome. I'm just logging in, making sure that we give a little moment here as people are going to start filtering in. And we're going to have a great show tonight, a lot of things to talk about. And it's going to be very specific. As you guys see directly below here, we are going to be talking about the margin. And we got Bill Gould is first into the room. Let's see who else bounces in. We got to get this tweeted out. We got to get the word out on the street. So while we do that, why don't we run the intro and we'll be right back because it's all getting ready to start right now.
Are you down with OTC? Please like, subscribe, and click the bell to be notified when the next video drops.
All right. Okay, we're back. I hope that was a solid intro. That wasn't an intro, that was an outro. Oh, that's hilarious. I don't know what's going on. This is the second time that's happened to me. I played the outro. That's okay. Let me play that again because that reminds people, subscribe and hit the bell notifier because that's what we want. We want you guys to subscribe. If you're brand new over here and you're watching this on the playback, this is for you.
Are you down with OTC? Please like, subscribe, and click the bell to be notified when the next video drops.
All right, there we go. That's how we do it. We want you to subscribe, hit that subscription down there, hit the bell. Today we're going to be talking about margin. We're going to talk about what it means to lose your ass on crypto when you're not paying attention. And unfortunately, there are a lot of exchanges out there that are issuing margin in crypto as it is on the stock market trades. And a lot of people lose their ass in margin in regular stock. And now in this volatile marketplace with crypto, I think this is extremely, extremely dangerous. What do you say, Nick?
It is. Look, anytime you extend people leverage, you give them a credit card, give a 6-year-old a credit card or a high school kid a credit card, and it's like a blank check. And so I think that humans are just not good at kind of processing the ramifications of their fiscal profanity, right? So like textbook definition, a margin account is a brokerage account in which the broker lends the customer cash to purchase stocks or other financial products, in this case, digital assets or crypto. The loan is in the account is collateralized by the securities purchased and cash and comes with a periodic interest rate. That's another thing that I think maybe people miss is that there's interest attached to all this. So it's all the worst parts of a loan shark and a credit card rolled up into one. By the way, in a market that goes 24 hours a day, 7 days a week, and there's no sleeping. So if you're in a margin position in crypto and you go to bed, you know all the shenanigans that can happen, and you can wake up with zero.
That's definitely problematic.
Completely blown up, yeah. And I think we saw that a few weeks ago, definitely, with a lot of this DeFi, some of these platforms where they're letting you get just massive leverage, just an unhealthy amount of leverage. And, one of the arguments is, well, all of these guys at hedge funds and, they do this all the time. Yeah, and they get blown up all the time too. I mean, they tank hedge funds. They die all the time for this kind of thing, for, not appreciating how much leverage can really do damage.
Yeah, man, that's crazy. So, and especially in a volatile marketplace, right? So here we are, and it's not only volatile, but it's speculative. So,
Right, and illiquid, and it's illiquid.
And illiquid, right? So you got everything kind of leveraged against you, and here we are utilizing margin calls or margin to invest. Now, here's what we really want to dig into, and here's hopefully we can get some participation from people that are bouncing in. And if you guys can do us a favor and tweet this out, I see Chip in here. Chip is in the chat. Chip, if you can tweet this out, if you can throw it into the different chat spots, if you can throw it into the Telegram, that'd be really helpful and get the word out on the street. Any questions that you guys have, definitely throw them out there to us. We'll definitely take some questions. So I'm gonna put a little note here, taking questions on margin.
Does everybody? How many people are in the chat right now?
We've got we have 11 people in the chat right now. We're
Do at least the 11
slow.
people here? Does everybody here know what margin accounts are and how they work?
That's a good question. That's a really good question. I think let's start there. Why don't we start with explaining the idea of what a margin account is? Because I think it's going to be, equally important then as we, explain the margin account and then try to explain what people get into, drawing, I guess, a comparison with what some of these exchanges are offering, whether it's we were talking about it earlier. We were talking about Celsius. We were talking about Nexo, that they have lending accounts where you're staking 2-to-1 to borrow against your crypto. Bitrue is doing it. Binance is doing it. Coinbase is doing it. Uphold is working with a partner to do some lending. And you can also invest. I mean, you can stock or stash your crypto for interest. But that really wouldn't be a margin. So why don't we start there? Let's talk about what is a margin, and get a good understanding.
So there's a couple ways to look at it. One way is to keep it in terms that make complete sense. So when you buy a house, you're using leverage to buy a house. So a typical home loan, you're putting 20% down, right? So if the house is $100, you're going to put $20 down. Well, they've extended you 5x leverage, right? So you 5 times your money, right? You took that $20 and you're securing $100 worth of property, right? So the same happens on exchanges. So I might open an E-Trade account as an example. With E-Trade, you put $25,000 in an account. You can then, that's the minimum margin requirements set by the SEC. At that point, you can borrow $100,000 against that $25,000. So, which sounds cool. You're like, listen, if I know what I'm doing and I pick this stock, it's going to only go up because, I know how to pick stock or whatever, right?
That's
and
right.
So you say, well, if I could gain 5% a year off my 25,000, well, if I had 100,000, that's 20%. 20% of 100 grand. Now I'm making 20K a year. I only put 25,000 in. I'm making 80% on my money. This is crazy. But there's strings. One is that all of these margin accounts, they all have some interest accumulating in real time, 24 hours a day, 7 days a week. So you need to factor that in. You also need to factor in that if I put $25,000 down, and let's just keep it simple. It's 2-to-1 leverage. I put 25K in. I now have $50,000 worth of spending power. If the market turns sideways on me, like with Bitcoin the other day, it had that kind of crazy, horrible evening where it went from, like 6,500, it touched 3,800 for a few seconds and bounced back up. Well, that was almost 50%. In a scenario like that, just with 2x leverage, if the price drops by 50%, you're going to get liquidated and you're going to have zero. You're going to have nothing left because remember, even though you've put $25,000 up, you've bought $50,000 worth of crypto, right? Or anything, whatever it is, worth of Bitcoin. If Bitcoin drops by half, well, the exchange is not losing money. You're the one who's losing money, right? So what happens is they'll start liquidating your position. And at the point where it gets to a full 50% loss, your entire position is liquidated. Now, they all have different rules about how they liquidate, but you need to understand the basics. That they don't just wait and, we both took a loss. No, you're going to take a loss. Your equity is going to take a loss, not the exchange's equity. So then you have to do the math and say, okay, what does that mean? Let's extrapolate that out. Some exchanges might allow 4-to-1 leverage, right? So your 25,000 now has, right, that $100,000 we were talking about. But what if it's 10-to-1? Well, now it's $250,000 against your $25,000. But the greater the leverage, the less it has to drop before you start getting liquidated or margin called or squeezed out. And if you don't, and even if it just bounces down for a few seconds and then goes back up, and you're like, well, I'm doing fine now, it doesn't matter, because if there's ever a point where you go into liquidation, they start liquidating your assets right then. Or they have a margin call, like in the stock market, you'll get a margin call and you have 3 days to satisfy that.
Right.
But if it moves too fast, you'll have forced liquidation. And so you can see where, if you do the math, if a bunch of people have a lot of leverage, if a bunch of us have 10x leverage, well, what can happen is maybe your position, you're more leveraged than I am. Let's say you have 20x leverage. You put in your $10,000, but you have $200,000 worth of buying power. Well, that means that if the value comes down just 5%, you've lost everything. You're liquidated. Now, once you're liquidated, that might cause the price to gyrate down. And now I start getting liquidated. And now my buddy down the street starts getting liquidated. And all of us with leverage start imploding at the same time. And that can create these massive, really fast moves in the stock market. So sometimes these moves that you're seeing are greatly exacerbated because of leverage. A move that would have only been 1 or 2% becomes an 8 or 10 or 15% move, because most of that liquidity is in the form of leveraged positions that start getting beat up. And as they get liquidated, that causes more liquidations and more margin calls. There's even people, unscrupulous investors, whales, that will go margin hunting, and they'll find a shaky exchange where people are leveraged to the hilt, and they'll go in and they'll put a bunch of, they'll transfer, say, 10,000 Bitcoin to that exchange, and they'll transfer, $20 or $30 million to another exchange or to several other exchanges. And they'll start selling. And by the way, they probably also put on a short position and on as many futures exchanges as they can. So they'll start selling their Bitcoin, which starts forcing all these guys to get liquidated, even if the price, if they can just move it a little bit. And remember, they don't have to do it on every exchange. They just have to beat up one exchange. So as the price starts dropping, there's a crash. That panic starts panicking other exchanges. People start getting forced liquidated, especially if they had all this leverage. Pew, pew, pew. All these forced liquidations happen. They start hunting for all these people that had margins. Those guys get margin called. They get beat up. They get liquidated out on another exchange. As all this bad information is spreading out to other exchanges, a little bit of panic sets in. So one exchange, one guy on one exchange can force some liquidations. That promulgates out. Other exchanges start getting sold off. By the way, he's making money. His short position is skyrocketing. He waits. He starts buying his tokens back, but he doesn't buy them all on one exchange. He buys them on a bunch of exchanges, or he buys them, not even on an exchange, but he can flip his position. This is how a whale could do it. They can flip-flop their position. They can buy all those coins back at a deep discount. Now they have a long position they just set. So they're making money not only on the actual position of their Bitcoin on the original exchange, while everybody else is getting liquidated, they start buying it back at a deep discount, the same coins they just sold 3 minutes earlier. And this is how these things happen all the time. And it's not illegal. It probably would be illegal in the stock market, where you're manipulating the market. But in the crypto space, this is the Wild West. So when you have these advanced trading products in this illiquid market and you have no rules, well, then you should expect it's not manipulation. It's just business, right? It's fair. And so this is the Wild West. And you have to, the Wild West is a dangerous place. And so I think right now, margin and these kinds of collateralized positions is the most dangerous thing people can have, because these guys are going to bully you with you're being a little bit overzealous and greedy, and they're going to bully you out of your positions. And when Bitcoin is 100 or 50 or 200 or 700K 3 years from now, you're going to think back and go, man, I got beat up in the margin. and I lost all my coins because I was just being greedy.
So really, you think about, people that are utilizing a margin account. You would think, oh, you're trading, right? So you're playing with the market, you're taking the risk. If you're willing to take the risk, you have to be willing to take the losses. You're not just getting the gains. But I think that the big misunderstanding with all of this is that when you go to these exchanges like a Nexo or a Coinbase or Uphold is offering it, and Binance and Bitrue and on, where you're able to borrow against your digital asset. So let's talk about that a little bit, because there's some pros and cons with borrowing against your digital asset. And maybe in some scenarios, the pro will outweigh the cons of, putting up your, digital asset and borrowing against it. But timing is everything, isn't it? Because, let's talk about that. Let's hash that out, because now that we have a better understanding what the margin is, and a margin account, when you're putting up your collateral to borrow, you're essentially opening up a margin, right? It's a margin account, a little bit different. It's not
Right.
exactly, but you can still get liquidated from that position as well.
Sure.
In there, so
Sure.
that's a little scary. So let's go through it, I guess, step by step, and try to understand the dynamics of what these guys are offering. When you're
So
staking, yeah.
sure. So on some of the exchanges, the way it would work, like an Uphold or something like that, they're going to give you some collateral value. So for instance, they might pay you, 80 cents on the dollar. So I put in, 10 Bitcoin. I might be able to cash out 8 Bitcoin worth of USD. And my Bitcoin collateralizes that loan. But again, if the value of that Bitcoin goes down, if they gave me, if Bitcoin's at $10,000 and I put 10 Bitcoin in there, they can give me $80,000 against that. Great. But if the price of Bitcoin goes down to to $5,000, then that means my collateral is only $50,000 on that 80,000 that I borrowed. Now, in a case like that, they're not going to liquidate you right off the bat. They're going to say, fine, you owe us the difference. You have to service that loan. So it's not as dangerous. You have a little bit of a cushion, and there's some tax benefits to it, right? So, for instance, if I collateralize a loan with Bitcoin and I take out, that $80,000, I'm not charged tax on that because that's debt. So you're not charged tax on that debt, which is nice. Some people might say, you know what, I'd rather do that than cash out and have that tax implication of either 15 or 30% if you're in the United States, be it short-term or long-term gains. So maybe it might make sense. Now, I would say in a bull market where we have a slow march upward, and maybe a year, 2 years, 3 years from now, where the market is a little bit more stable, there's more liquidity, there's a little bit more price discovery, and I don't think Bitcoin's going to sell off 50% in a day. Of course, we might not get to that. That might be 10 years off. But whenever you think you're in that kind of slow march upward, it might make sense to take some money off the table in that manner. If you were going to put that money to work in a way where you were going to be making enough money to service that debt. So for instance, maybe I'm taking a loan to buy a house that I'm going to use as a rental property. Well, that would make sense, because then I have the income coming from that rental property that I could use to pay any kind of margin call I might get on that loan, as if that collateral dropped. So I'm getting the best of both worlds. That's the have your cake and eat it too that we were discussing earlier.
Right. So you don't want to you don't want to put the loan in and say, oh, I'm going to use it. Now I'm going to go buy a car or a depreciating
Right.
asset. And
It
now
can't. Yeah.
it's going to be negative. I mean, there's, you're taking money back out of your pocket now, put it back into your investment. I guess you could look at that in different ways, right? I mean, especially if there's a little volatility in the market where you're taking a risk. Now you're going to have to, make good on that loan if the market drops, um, and you're still paying whatever you have to owe, you pay back. I know on the Nexo, I think the interest rate is 5.39%. And so if you, and they're taking your interest, out of money that you already have, sitting there, being held as collateral is how it looks. I was trying to get a better understanding of the way they did that, but it makes the most sense because they want to collect their daily interest. So they're collecting their daily interest in case you pay the loan back in 5 days. They want to collect 5 days of interest. They're not. It's not a traditional loan to where you're based off of an annual interest rate. Broken down. Interest, and you're now paying it back monthly. Here they're taking your their interest on a daily basis. So where that you have to factor where that money's coming from, right? So I
Right.
think
But
that's another.
I agree. Yeah, I think, and again, I haven't peeled back the layers of that onion specifically, but most of the way they do that is it is an annualized rate, but it is broken down into days.
Days, right?
Right. And so that's how they can kind of keep track if you're doing short-term loans, because that's basically, they're assuming people are trading in and out. You might hold a position for a few minutes, up to a few hours. You definitely don't want to do this as a long-term investment strategy, again, in a really illiquid market. And look, you didn't want, the stock market, the Wall Street stock market, people were way over leveraged. So this isn't just a crypto phenomenon. This isn't just like we're idiots and the guys on Wall Street really have their stuff together. Those guys got bludgeoned. And, as we were talking about the other night, there's still probably some hedge funds that didn't make it out of the carnage a few weeks ago. And there's, those bodies will float to the surface over the next few weeks. But when people get blown out in crypto, you have to understand this one thing more than anything else. This is an extremely illiquid market. So technical analysis does not work. Okay. All of these kind of graphing softwares and stuff, they don't function properly because, again, we don't really have true price discovery. If one investor can go on one exchange and bully the price of Bitcoin around the entire planet down by 30 or 40% with 10 or $15 million, well, then you have to go, okay, these markets are dislocated, right? So
True.
Again, and these are all these things, these are the growing pains of this new digital asset class. And they get better with time, and they get better with liquidity. The market is certainly, you would say it's a lot more dangerous right now than it was in the peak of 2017 when there was almost $1 trillion in the space. When the markets got beat up then, it took almost a year for Bitcoin to come back down in the same percentages that it does now, sometimes in an evening.
Right.
But again, that's just a lack of liquidity. It's not a lack of functionality or technicality. So what you don't want to do is, I don't think you want to gamble into that space. It's like if you went to the casino and the blackjack dealer, he's like, well, how many cards are we playing with? Well, 7. What? No, there's only 7 cards. Oh, crap. I mean, that makes every card really valuable. And so again, we're in a very illiquid space. And if you borrow and get leverage into an illiquid market, you are taking a lot of risk that I don't think people should take, especially if you believe in this space. Then you need to just, we always say only use money you can afford to lose. Well, don't add leverage to that, because then if you add leverage to that, you've just blown the whole theory. It's right. No longer what you can afford to lose. It's some factor of that.
Yeah, that's it. Yeah, and that's the thing. I mean, I look at this space. Any investment. There's always an element of risk to that investment. And here we're in a newer asset class, newer investment space, and it's definitely new considering it's been around for just over 10 years. So it's not, it's still fledgling for all intents and purposes. And so now we already know we're taking a degree of risk getting into it. Why would you want to increase that risk exponentially by then risking your investment? So it's already at risk, and now you're taking another level of risk. You just keep adding layers to it. That just doesn't make sense to me. Now, on the other side of it, when you get into some of these exchanges where you can put your digital asset up and actually gain interest off of it. Now that's a little bit different. And maybe they're paying you 5% interest, 10% interest, you just want to make sure in that case you want to leverage your risk and make sure to the best of your ability that that exchange is going to be a viable exchange, that they're putting it in some form of third party custodial servicing, what have you. What are your thoughts?
So my thoughts are this: we know how risky this space is, and interest paid on any asset is a measure of risk, right? And that interest or yield, as you hear people hunting for yield, that's just a dickish way of Wall Street guys saying looking for interest on an investment, return on investment. So whatever that interest is, that's supposed to be a measure of risk that's commensurate with the risk you're taking. So you have to remember that if you're getting interest on something, it's because they've introduced risk and you need to be prepared for loss. So is that level of interest or yield equal with the level of risk you're taking? On a small illiquid exchange in a basically illiquid market, if things go the wrong way for them, is your Bitcoin still going to be there? And I'm hesitant to think that any of these exchanges, except maybe Binance and Coinbase, I don't know if anybody else has the money to cover a massive panic. And I don't think 5% or 8% or 10% is enough. I like the way that Uphold is built, the way it's designed. It's very easy to use. I think they've got a really good team there, but I don't think they are liquid enough to handle a catastrophe in the market.
Yeah.
And if they're not, is that 5% or 8 or even 10%? All right, 10% sounds great, but is it worth it? When you go to sleep at night, is the 10%, is the 10th of a Bitcoin you make per year worth potentially losing your Bitcoin? I say no. I mean, I have a little bit of money, a little bit of Bitcoin, and some other assets spread across a few of these exchanges. I have some on BitTrue because I really like the way BitTrue works. I'm a little worried about their liquidity. It's no way to really know, I suppose. Binance, I'm not worried about. Coinbase, I'm not worried about. Well, that's, of course, look at Coinbase. You don't make anything off those assets. You make like dirt, right? It's like you might as well not make anything. Then you have the Upholds and some of these other exchanges and even BitTrue where you can make on some of the assets 10. I saw 13% on USDT. Well, let's do the math on that. Where are you getting 13% on US dollars? Who's right. Other than the Fed? Who can guarantee that kind of yield?
You're not
so you have to go,
that.
man,
yeah.
There must be an undue amount of risk on the other side of that because that's a trade. You're trading your Bitcoin for some risk, and, right. and the return is that 13%, or you're trading your US dollar. I would just say that if you unwind that or unpack it, man, I think that's a lot of risk you're taking for a very little return.
Yeah, too much. Now, here's something interesting because you talk about whether or not BitTrue has the liquidity necessary. Are there? If we look exchange to exchange, there could be some fundamental concerns with the way they operate the exchange. Maybe lack of transparency. Maybe being self-insured. Maybe not utilizing a third-party custodial service to audit and to support their cold wallets. When we had the CEO of BitTrue on, Chris Wang, he explained a lot of it. I still have some segments of that video that I'm going to be cutting up when he talks about being self-insured. Why did he choose that methodology for their exchange? Why aren't they using a third-party custodial, et cetera? So there's some really interesting segments that we're still going to put as in a shorter segment to pull out of that long video we did. But one of the things that concerns me, and you talk about lack of liquidity, and I could be 100% wrong with this because right now with the times that we're facing, there's a lot of people that need money. Potentially, right? They're out of a job. They need money. They have a tied up investment. They want to pull it out. They want to borrow against it. One of the things that Chris Wang announced on BitTrue is that they were offering 0%, a 0% loan interest. And so I thought that was really interesting. So a couple things that I think of. One, out of the goodness of their heart, to help people and to help the community because they're very community driven. They decided to stake their investors and say, hey, we know in the time of need, but we're going to offer this money to you, 0% interest on our part. We're loaning it to you. It's still the same. They're staking 2-for-1, right? So you have to give them. I gotta believe. I think their system works the same as everybody else. You have to put up 2 for every 1 you're borrowing. So really, they're not taking a large degree of risk if they have to call that loan at some point and say, but they're not making any money on it, zero. But at some point, if the market goes down, they're going to tell people you have to make good on the account or we're liquidating it. So is there a degree of risk? And before we get there, the other side of it is they don't have the liquidity. They're in need of money, and they're trying to figure out a way to get more liquidity and cash flow moving through the exchange. Which side do you sit on, or is there a third position that you think might be more appropriate?
Well, I think it's coming from the right place. Maybe they're doing these zero interest rate collateralized loans to help people out. That's kind of a cool thing. However, just like a bank, that money's not just sitting in accounts. I would wager that money's being loaned out, right? That Bitcoin's being loaned out or leveraged. I mean,
Right,
these guys
their
make their
side.
money off trades. They make their money off trades and they make their money off lending. There's a lot more money in lending, and that's why they're all rolling into this space. I think, my worry is, again, liquidity of the exchange itself. For instance, we can check right now the liquidity of Bitcoin. We can go see what the total market cap is and where all the coins are down to the last penny. We can do it for XRP. We can go see exactly, how many XRP are out there, essentially where they are, what the market value is up to the last 10 seconds. So I wonder why we can't do that with exchanges. I think that information should be exposed. I would like to see the fiscal health of an exchange, right? So that
That's a good point.
Why isn't that available in real time? That's something that's always I've just wondered why that's not available in real time.
Yeah, should that be transparent in real time? I mean, you'd think everything in the blockchain, everything is real time.
I think you should be able to check the financial health in liquidity of an exchange in real time. I should know that Binance has $926 million in cash and in crypto, and I should see a dollar amount of what they're worth if they got liquidated today.
Right.
And then I could see, assets and liabilities. I should be able to see their balance sheet the same way we'll kind of look at the Fed balance sheet, right? We should be able to see these exchanges' balance sheets, assets and liabilities. Yeah. How much coin do they have on deposit? How much have they loaned out?
Right.
We should see all that.
Especially in that environment. I mean, if they're loaning out money, we definitely want to see how that looks. So could you imagine you're not just putting up your money. Now, here's something else to consider. In the Nexo model, your money is going, the money that you put up, your 2 Bitcoin for every 1 that you borrow is going to BitGo. It's a third-party custodial service that's holding that asset. So if Nexo goes away, your money is still preserved in this custodial account by BitGo. That's how it's supposed to work. As long as there's transparency and it's there, supposedly they have the process in place so that it's visible and transparent. You go to a Bitrue site or Binance or some of these others that are self-insuring and self-managing, I still have a big concern about that. So I feel that there needs to be someone that's holding an escrow, similar to a letter of credit. If I'm doing business with somebody in another country and I've never met them and I don't trust them yet, I'm going to utilize my bank, which is going to use another third-party bank in between my bank and their bank that's going to hold the letter of credit. and hold the money in between until certain events happen. So that's the necessity of the third party. If you're self-managing that process, there's no third party involved, then I'm a little skeptical of that process. So whereas Nexo is utilizing a BitGo, there's a third party involved, gives you a little bit more comfort. Not to say that it's that Nexo, something happens, they go away, and now you're fighting to get your money back because it is being held in cold storage, by this third party. Whereas, Bitrue, let's say, or Binance, or one of the others, something drastic happens and they go under, and the lawsuit maybe they're trying to make good with all their investors, but I don't know. I mean, what do you think on that side of it? Third party necessary or
Well,
not so necessary?
I mean, again, you get into the trusted third party argument. These are all problems that we are facing because we're trusting a third party. So this is essentially a third party squared, right? In our case, the third party is the exchange. So now we have a trusted fourth party, I mean, whatever one to call it, that's, who watches the watchers. So it's like, okay, one, we probably shouldn't have much of our, you don't want to have more than about 10% of your assets on an exchange, period. But for some people, it makes more sense to have them on the exchange because it's kind of difficult to manage your own keys. And I get it. Right now, it's still a little bit clunky, and we haven't necessarily solved that yet, other than, the hard drives, which is
Right.
fine. But so let's say that my 65-year-old grandma, she's going to lose her nano and her passkeys and all this. So for her, look, throw it on Coinbase, grandma. You got your Bitcoin, you got your 10 Ethereum, you're ready for the future. Well, that's fine. So then you say, okay, how do we protect ourselves from that third party? Because they're now the custodian. So we're going to give the custodian a custodian.
Huh.
Right? So it's like, okay, now I got to trust the custodian of the custodian, the counterparty of the counterparty.
Right. Yeah. How many layers?
So yeah, how many layers does it go? I think the future of this, fast forward 3 years, I think that the Fed's going to underwrite everybody. I think these exchanges will have Fed accounts. I know that makes people, but as far as having a backstop of pure liquidity, I mean, it's going to probably happen. It's all the prime brokers, all the prime banks already have Fed accounts. They're going to be opening up accounts to everybody else. Heck, we're going to have Fed accounts. So there's a point where, if the Fed becomes the lender, purchaser, buyer of last resort, the owner of last resort, they're already the biggest real estate owner on the planet Earth. So if you do the math, I mean, at some point, central banks are going to have everybody's accounts anyway. Maybe the counterparty of our counterparty is just going to be the Fed or some other central bank. And then you're just choosing which central bank you want to be a counterparty to your crypto exchange that you use. Hopefully, maybe these decentralized exchanges will start to show up and have more utility. And then you'll only have to worry about one counterparty. But until we get there, counterparties of counterparties of counterparties.
Well, you have to trust. At some point, you have to trust one of the counterparties. You have to trust that third party. So it has, and that trust, I think, kind of goes to the level of what's accepted in the community. So if the community accepts that third party as an esteemed member, that you can trust, but it has to be backed up by something more than that. Like BitGo is backed up by I don't know, Goldman Sachs or I don't even know if they're still around. Are they still around?
Because
But
there's
somebody.
because
They're backed up by somebody.
because Goldman Sachs is known for being so honest and transparent.
Right, yeah. Hey, there you go. See? But they're still backed up by a mainstream entity right. And so, right, we still have a little bit of an issue. Maybe we should trust the nodes over the and the decentralized method maybe works better. And so we were talking earlier before we got on here that you're still not 100% confident with the decentralized format. So these DeFi's where it's all happening behind the scenes, automated in a decentralized fashion. You want to borrow, you can borrow. and there's some automated state behind it, but that can be taken advantage of and manipulated in some way, shape, or form, but right now it's limited, right? I mean, I don't think you have a lot of access to it, and there's probably some downside to it.
Well, it's not as limited as you would think, because you can create what are called flash loans, and in flash loans, they're these instantly executable loans, essentially a smart contract that it's an all or none. So either, like for arbitrage trades, and just to make it simple, an arbitrage trade is on exchange A, Bitcoin is 10,000. On exchange B, Bitcoin is 7,000. Well, if I see this, I can go, wow, well, I can sell the expensive one and buy the cheap one and collect the spread, right? And so if you have money in both places, you can do that, right? If you have Bitcoin, if you have money over here and right. So those are arbitrage trades, and they happen all the time. And now you have bots that do those little trades, and they look for tiny little fractions. And so again, if you have a lot of money, so what people do is there might be just a tiny little difference in price. So they'll do a flash trade where they'll borrow a whole bunch of money and they'll buy a whole bunch of this one and sell a whole bunch of this one that's just a fraction more expensive, and they'll collect that spread, but that spread times 1,000 looks like a lot.
Yeah.
So they create a smart contract flash loan, okay? And without kind of digging too deep into it, and that instantly executes. Boom. But the thing is that on these exchanges, you can set all sorts of things, all sorts of parameters. So for instance, what my collateral is, and this is what some people were doing that were pretty clever, is they were getting their collateral in terms of a certain coin. Well, let's call it S coin. And then they would look for another exchange where S coin was also trading, where the volume was really low and it was illiquid. And remember, that's the coin that they're using as collateral. So maybe they borrowed 100K in terms of S coin. And so they put up 10K against it, right? Well, then they go to this other exchange and they will buy, with the money they just borrowed, that same coin that they're holding as collateral. They'll buy S coin, they'll pump the price up 5 times its value. And now when the information gets across that, hey, this coin's actually valued much higher, so this coin rises in value, meaning that their collateral is much greater, meaning that they can instantly cash out of that trade, and they don't owe as much because their collateral just went up, meaning instead of having 10% collateral on that 100,000, they had 50% collateral. Now they haven't done anything. They took the money, they borrowed the S coin to jump up the price of S coin, to get out of S coin, to raise the value of their collateral on the coin that was collateralizing their collateral. So
it's a whole, you got to be well educated in that to make sure you do it right.
Yes, you got to do it right, and these transactions are instantly executable. So a lot of money, a lot of liquidity is produced in these flash loans. So that's just one example of the kinds of things you could do and the kinds of shenanigans. And again, it's not really illegal. It's definitely immoral. But I mean, these exchanges are making money from you from trading. If you find a legal way to kind of tilt the system in your favor, I'm not so sure that's even immoral. I think that's just game.
But the problem is, though, on these exchanges, if it's a trading exchange, a trading platform, for every buyer, there's someone selling, right?
There's a sucker born every minute.
But the question is, though, since you're arbitraging, you're moving from one platform to the next, are you really taking advantage of anybody at that point? Because you're buying at a low price over here, and on this other exchange, that's the rate, that's the going rate, whatever it is, that's higher. But it could be incrementally higher. It doesn't have to be, like you said, it could be a 3% difference in value, but your 3%, depending on how much you're buying and selling, that 3% can equate to a decent number. You're not taking, a major risk. That your movement, if it's well planned out, then it's doable, right? So now, but the problem is offloading it. So now you sell it, as long as your platform, your exchange, you can sell it into something that's transferable off that exchange. And so the question is, can you do that with some of the top assets like a Bitcoin or an Ethereum or an XRP or, what have you?
Yes.
That's there you go. So if you can do that, you just need bigger numbers. You have to have bigger dollars to invest
Which means
versus if it's some obscure S
leverage.
coin,
Yeah.
right? You have the obscure S coin that who knows what it is, but you had to move your Bitcoin over here and you buy the S coin to buy it over there and you're playing around with all this stuff, but you have no way to get back out. So now you're stuck on those exchanges, and the time
Yeah.
involved, right?
You can be stuck on an illiquid exchange. But this, just so you know too, and so the guys that are watching know, and gals, this isn't anything new. I mean, this is what the bond market is. I mean, this is what people do all day long. If a hedge fund needs to make 7.5% a year in order to pay their redemptions, and they can only find a yield of 1.5%, well, then they need to get some 5x leverage to find that 7.5%. So that's what they do. They'll look for a guaranteed arbitrage, and it could be bond spreads. Many times it is spreads between bond rates, or the assumption that we're going to go negative. So if I'm at 1 and we go negative, boom, there's my 1%. Now if I do that 7.5 times, so all I need is 750% leverage. So and that's why traditional markets are blowing up right now too. And why we haven't seen we're going to see some carnage, and we're going to continue to see carnage, because this system, the crypto space is an interesting microcosm for what's happening on Wall Street and in world financial markets, because the same shenanigans are happening, but they're happening, at much bigger proportions in the, I won't call it the real economy, but I will say the world economy. But again, and they're much more liquid, well, you could argue, but there's much more money floating around in those markets. And so there's a little bit more, you would think, price stability, because again, when you have illiquid markets, but then we have in the traditional stock market, let's say you have NASDAQ, you have, ARCA, you have the New York Stock Exchange, NYSE, you have the different, a couple of exchanges, in Japan, you have the Nikkei, you have, right? So every country has, 2 or 3 exchanges. In crypto, we have hundreds of exchanges. We probably only have like 4 good ones that have any liquidity, but you have tons of exchanges, and it's very easy to get landlocked in some little exchange with no liquidity, or they just disappear. The whole thing was a scam in the first place. Right. And so you just have to be very careful. We're in this, you kind of have to treat it. I see a lot of exchanges, but I probably only use about 3. And it would be Binance, Coinbase / Coinbase Pro, Bittrex. Beyond that, you're taking chances. I would say Kraken is a safe exchange.
Kraken's been around for a long time. Yeah,
Kraken's been around for a long time, so that would probably be my number 4. I don't think there's a good number 5. Not anybody that I really trust. I mean, that's kind of it. And I think if you're on these other exchanges, buyer beware.
Yeah. And then here's some good comments here. I definitely want to, shout some people out here in the chat, because, we've had some good interaction. I've posted a few of the comments, but VetPro has been posting some decent comments throughout, and then Biz Comedy and Connie and Jade, and I'm just watching the exchange kind of go along here. With the last one that he had mentioned, going back to utilizing some of the top 3 coins in arbitrage, but using Bitcoin, he said maybe using a faster coin would help, because the Bitcoin transaction can take too long. If you're moving and trying to buy, sell in Bitcoin, you might be stuck.
So let me give you, so arbitrage 101, you don't do it with the same money. You need to think of arbitrage in terms of four bricks, okay? Let's say you're doing Bitcoin and US dollars on 2 exchanges. You need Bitcoin in both accounts, and you need US dollars in both accounts, and they need to be equal. So if I have 10,000 here in Bitcoin, let's just say Bitcoin's at 10K, and I want to do a one coin arbitrage. I need 1 Bitcoin and 1 Bitcoin and $10,000 and $10,000. Okay. And that'll let me do one transfer, one transaction. Okay. And if the prices aren't doing this, right, and sometimes they kind of gap and stuff like that. Occasionally they go back and forth because that's price discovery, right? But you think of it as you need four tranches. You need your digital asset that you're arbitraging, and you need cash on both sides so that you can go back the other way. And so then the time doesn't really work against you. I see what he's saying. If you were using the same money, if for instance, you were trying to sell this Bitcoin, then move the cash over, then buy it on the other exchange, that wouldn't function because you need to do nearly simultaneous transactions. You need to go sell by, right? And then the price moves, sell by at the same time. If you're more than a few seconds off, you're going to miss that window. And so when I was doing this by hand for a while, I was just using Bittrex and Binance because to me, they were the most liquid. And I was using, in my case, I was doing Ravencoin. And so I had, and I won't say what I had, but I had a chunk of Ravencoin on both exchanges, and I had a chunk of Bitcoin on both exchanges. And that was the only way I could do it. And then what I had to do is after a few trades, you end up with one exchange where maybe the gap opens up. It's like 1%, 2%, 3% for a while. And you end up selling all of your expensive coins and buying all the cheap ones. Meaning when I sell this, when I have a bunch of dollars over here, and I was going Ravencoin to Bitcoin, but let's just keep it easy. I was selling. So I had a bunch of dollars over here, which was my profit, and had a bunch of coin over here. Now, technically, I haven't made profit until I've either sold the profit on one or the other. Meaning, if I just sold my Ravencoin, for $1 and bought it for 90 cents, I've made 10%. That 10% is actually over here. So you have to decide what do you want to hold it in, right? I was using Bitcoin as my base layer, but you could use XRP. The problem is XRP was not as liquid when I was doing this. And so there weren't good, in my case, Ravencoin XRP trading pairs. They weren't liquid enough for me to do this. You have to be in the most liquid coin. And that was, in my situation, it was Bitcoin is the underlying currency. And so, yeah, once I do all the trades and all the coins are on one side and all the Bitcoins on one side, you got to split them again. Cut your coin stash in half, push it over, cut your Bitcoin in half, push it over. That's going to take you probably 10 to 30 minutes, and then you're ready to trade again. But you need to go take a cold shower, get something to eat, and, hit a line of Coke or whatever it is that keeps you in the game anyway, because when you move money like that, if you do it wrong one time, you're going to get crushed. And so the other thing I learned is always do the sell first and the purchase second. Because if I sell something, I can take my profit. And if I miss the trade, well, the worst case is the price goes up, but I didn't lose any money. So if you're going to arbitrage and you're going to finger it, sell first, buy second.
That's crazy. No, that's really, that's insane. I can't even imagine. That's the stress alone would put you over the top. And now there's bots that do it for you. So you figure out how to program the bots and get that all set up. And then you have to trust the bots that they're doing everything. But you got to monitor that because, but the bots are looking for all those different margins automatically. And it's just happening so fast. Like you said, you just got to set it on autopilot. As long as your program is functional, that's interesting. That's just just a different level. I don't know.
And you also get in trouble from the exchanges because I was getting to the point where I was doing 100 Bitcoin a day. And that gets to the level where the exchanges will send you a note and say, we need to have an interview and make sure that you're not money laundering. But then what you do is you just expose all your transaction records. You say, actually, no, I'm not moving money. I'm just moving it to another exchange to arbitrage. And when you expose your trading records, then they give you a pass. But that was kind of like the level where I was like, okay, up to, because if you do, like I was doing trades where it might take me, once I moved all the Ravencoin over, that was like 10 Bitcoin worth of Ravencoin, especially. Huh. So then I was like, crap, well, I only have 10 of those a day. So then I was like, okay, so I need to figure out the way to, and then if the price of the underlying asset that you're trading goes up, you need more Bitcoin. So I was like, crap, I need more Bitcoin to be able to do more trades. So then I was like, okay, well then I got to sell some of my coins to profit. And so I was having to rebalance those tranches. And yeah, it's a lot of work.
That's I can't. That's too much. Yeah, I mean the stress, like you said. I mean you don't sleep. Yeah, I mean there's no way. I mean or you just have to scope it out. Yeah, I'm gonna do it for this amount of time, but I can't
Yeah.
imagine. I mean the mental, just even trying day trading, outside. Forget about the arbitrage. Just day trading, the stress and the emotional turmoil that you go through.
Well,
It's
yeah,
it's amazing. I
it's
don't know.
awful. Why I like arbitrage trading, if you're going to do any kind of trading, that was my day trading because I don't care which way the market's going. I don't really care what the price is. I'm just looking for inefficiencies and information.
Right.
And that's it. And
Yeah.
information, inefficiency and price discovery. These things will all go away. Well, they become smaller and smaller, the gaps, to where humans won't be able to do it. People aren't arbitraging the price of Apple stock, right? Now, who knows? They might be, for instance, at 3 in the morning on the Nikkei, if whatever the representative stock of Apple is, if it gets tanked because Apple says they're not shipping iPhone 12s because China's shut down or whatever, then you might see. But you're not going, and this is because Apple's not traded on the Nasdaq and ARCA and the New York Stock Exchange. It's traded on specific exchanges. We have a different scenario in crypto assets where they're traded the same asset because it's money. Now, if you go to the FX markets, you see a lot of arbitrage going on. And they're studying information, looking for the moment where there might be a price disparity, and that dislocation, they trade on that. But again, these are machines doing it, not humans, because the fractional differences are so tiny that a human just you can't thumb it. But in crypto, you can thumb it, at least for now. So I like it because I'm not gambling. If I see a price difference and I can sell the expensive one and buy this one, I made money.
That's awesome. Yeah.
I made money. Now it might not be much money. It could be $56, but it could be $8,000. But the point is, I know for a fact that there's a price disparity. And if I see it on Binance and Bittrex, which are exchanges that do have good liquidity, I know for a fact that if I sell it at 10 and buy it at 7, I made that spread. So that's kind of cool. And I'm not trying to guess the market and reading charts and doing all that other kind of stuff that really sends you down a rabbit hole that ends in failure for the most part. Traders always get beat by hodlers or by investors. An investor holds for a year or more. A trader holds for seconds to minutes to weeks. And I think if you get out of that trading mentality, you're just going to be a lot more. You're going to be a lot happier.
Yeah, I think that that's definitely a big point to end on is that, trading trading versus the long-term, investing is, a big difference. And if you have the guts to do it, the arbitrage sounds like the way to go, but you can get killed there too if you don't know what you're doing. So, I think the key is, if you decide you want to trade, you got to know what you're doing
Yeah.
100%. But if you want to take the more secure route, just invest and diversify your portfolio, and you're off to a more relaxed
Yes.
you know
And
time. So
and don't use leverage. Don't use leverage.
no leverage, no margin.
Let the idiots do that. You can go through Reddit and see sob story after sob story about people who had a 200-300 Bitcoin and just they imploded in one trade. They imploded and now they have nothing and they're on the street corner or whatever. I mean, it's just some sad stories. And again, you don't need it. We have all the leverage we want. If you own Bitcoin and XRP and Ethereum, you have intrinsic leverage because you know where these things are going. You have asymmetric leverage, and just all you have to do is sit back and relax, and you're going to have all the leverage you want for free.
Yep, that's it. So on that note, and it's let's wrap up this episode of the Huddle Review with Jeff here and Nick Black. And as we dropped the other night, we will be having a bigger announcement coming up here Sunday on the roundtable. So stay tuned for that. Make sure that if you guys are watching this in the replay, make sure you tune in live to the roundtable at 8 p.m. on Sunday night because we'll be doing something really cool at that point. Some big announcements. So anyhow, with that, I think it's a time that we can wrap it up. And that's it. I think we're out of here. What do you think?
Thank you, everyone. Thanks for your time.
All right.